read a lot of articles on Seeking Alpha, and after every single article, I try to have a call to action and try to understand, is this something that I want to pursue or is this something that I want to avoid? In every single article, I look at it from that lens. Is this something that I'm going to look to adopt and to try to put into action? Or is it something that I read it, I thought it was interesting, but I'm going to stay away from it because it doesn't fit my strategy. And that's the beautiful thing about investing is there's different approaches, different time horizons, and there's many different paths that can lead to success. And so I don't want to stand here on this high pedestal and say that my way is better than anyone's, but I came across this article from UC and it didn't hit the mark for me. When I read this article, I was thinking, no, this is absolutely what I want to avoid in terms of this approach. And I've been following UC for well over a year. And I think he adds a lot of value into, the majority of the articles that he writes, the work that he puts in. I think he adds a lot of value. And I want to be fair when I say that. I do like him. I do like his content, but this article, it didn't do it for me. And the article is titled, "I'm Finally Buying Realty Income and Here's Why." Now, I'm on Seeking Alpha every single day and I read articles on a daily basis. And I also have been watching some of his videos on YouTube. Like I said, UC is very specialized in real estate investment trust. He's in the weeds and he understands the space better than I do because this is all that he does. Now, there can be pros and cons to being really niche because there's only 200 publicly traded REITs here in the US. And, there's thousands of different companies. And if he's just focusing on REITs, you can see that he has to get a little creative in terms of his thumbnails, his titles. It has to be a little bit clickbaity because that's the system that we work in, right? And so I just want to highlight that, creators like this, it can be very difficult because you have to do what works, and what works is obviously flames. If he makes a video like this, people are going to click on it because it's playing with emotion. What I want to say here is I'm going to tell you up front, I'm going to be very critical of this article because when I read this, I was like, no, I have that feeling where I just got to tell people, guys, this is what not to do. So with that out of the way, let's take a look at the article. It's titled, "I'm Finally Buying Realty Income, Here's Why." So let's take a look at the article. In the summary, it says Realty Income has underperformed its peers in the recent recovery. As a result, it has now become quite a bit cheaper. It's also posted strong second quarter results. I discussed why I'm turning increasingly bullish on Realty Income. Over the past year, I posted several articles that were critical of Realty Income. In short, I think Realty Income faces three main issues. And these three main issues are really, really valid. And this is really, really important. So the first issue that he highlights is that the REIT, or this company, Realty Income, has become too big for its own good. And its massive size is slowing down its future growth. Now, you can kind of dissect that with size comes scalability and with a higher credit rating. So there are pros and cons to this. It's not just a negative. I want to highlight that there, okay? The next one here is the REIT is stepping away from its main circle of competence and is now investing in all sorts of properties, including casinos, data centers, and even vertical farming. Now, with the casinos, I think they did like an investment, like they don't actually own casino real estate. Correct me if I'm wrong, somebody who knows this better than I do, but I believe they just invested like $1 billion or so in a casino, but they don't actually own the casino. Okay. It's like PepsiCo investing into Celsius. They don't actually own Celsius. They just are a shareholder of Celsius. Okay. But if you know better than me, please comment in the comments below if I misunderstood that. But that's my understanding of it. One thing that I do want to highlight here is he is absolutely correct. When you look, if a REIT is coming outside of its circle of competence, and if it becomes a diversified REIT, because you have to understand there's different sectors in real estate. You got cell towers, you got data centers, you got retail, you got all these different ones. And the diversified REITs generally have a lower multiple, a lower ratio in how they're valued. And so he's actually very correct when it comes to this. Diversified REITs, because it's difficult to value a diversified REIT because it holds different assets and all of these assets are valued differently. So he's definitely making a very valid point with this. The third one here is we think that its average portfolio quality has degraded over the years following its many acquisitions of lower quality net lease REITs. My main criticism of this article stems from this. These are the main points, the main arguments that he's bringing to the table. These are the three main issues that he has with Realty Income. And what you'll notice is what he's outlining in this video of why he's bullish has nothing to do with these three bullet points. But that doesn't mean that I'm bearish on the company. Wait a second, you're not bearish on the company. I thought you were bearish on the company. I guess this is not really bearish. Flames in a thumbnail, I guess, are just used to spark emotions, but I guess emotions are to be played with. When I see this, it's like, okay, it's going up in flames. Anyways, on the contrary, I gave it a buy rating in my last update a month ago, which discussed some of its tenant issues. So much changes in a single month. I just think that it has been overhyped relative to many of its lesser known close peers, and that's why I have not invested in Realty Income. So far, I have been right on that, as my pick Agree Realty, ticker ADC, has consistently outperformed Realty Income. This is true if you compare their results over the past decade. So this is why this article is not so great in my opinion. You don't make a decision to buy a company based solely on its peer, if the peer is better or not, right? Like, I get what he's doing here, and it's very much an active trader approach, like in and out of stocks. Like, this is not a Warren Buffett style to investing. This is not a buy and hold approach. Like, this is very much like day trading. You're changing, you're flip-flopping month over month. Like, this is like, I guess I'm not his target audience group, like at least his investing strategy, but this is like, if you want to actively trade in and out of stocks and predict when to buy and when to sell, like, this is so difficult to do, which we'll see here in a second. So moving on, this is true if you compare the results over the past decade, and it's also been true in this recent recovery. Realty Income has lagged behind, resulting in lower returns for its shareholders. But following all of this underperformance, Realty Income has now become quite a bit cheaper than Agree Realty, which makes it more desirable. This is especially true after Realty Income reported stronger than expected Q2 results. For these reasons, I now no longer have a preference for its close peers and am turning increasingly bullish on Realty Income. Now, wait. You're turning increasingly bullish because it's now cheaper than its peer? What? Above right here, you beautifully outlined the bear case for Realty Income. You outlined it very well in these three bullet points. This has nothing to do with what you just said of why you're turning bullish. This is why this article gets my blood pressure raising, guys. Like, you outline so clearly what are the bear cases for this company, and then the share price went down also relative to a peer in its industry, and therefore you're bullish? WTF. I can't wrap my head around that. Anyways, moving on, if anything, I think that Realty Income could outperform going forward because Realty Income's going to outperform because another company's going to outperform. What? My gosh. Going forward, because Agree Realty is now trading at a historically large valuation spread relative to Realty Income. Just 3 months, the spread was relatively small, with Agree Realty trading at a 1-turn higher funds from operation multiple, but it had expanded to a 3-turn higher multiple. This is not how you invest, guys. You don't invest like this. When you look at this, this will give me so much anxiety investing into my portfolio like this. The amount of time and stress that you'd have to put into your portfolio investing like this is no way to invest. Oh my gosh. I mean, to each their own, but for me, this is like my nightmare scenario. Especially in early retirement. Could you imagine this? Anyways, moving on, back when the spread was small, it was a no-brainer to favor Agree Realty because it owns better assets, has less leverage, and doesn't have to deal with the size issue. Okay, so the size issue, he does mention that in terms of the bear case with the size and has gotten too big. But I guess, is that really a reason to sell Realty Income? I mean, just because, I guess what he's arguing here is the opportunity cost, right? The opportunity cost of owning ADC versus Realty Income. You know, if you only had to buy one, right? And those hypothetical scenarios. If you could only buy one stock or one ETF, what would it be? Thankfully, we don't live in a world where you can only buy one, right? You could buy both of them if you wanted, but I don't see, because one company, that's like saying PepsiCo has a good quarter, therefore Coca-Cola is a sell, right? When you say that out loud, it's like, what are you thinking, right? Coca-Cola or PepsiCo is doing well today. That means you need to sell Coca-Cola and hope to time it perfectly that PepsiCo will outperform. Just that logic, I understand it from a trader's perspective. But for me, when I read that as somebody who wants to live off of his dividend portfolio in early retirement or even in general retirement, like the stress that causes, I don't see it. Man, the blood pressure of if you invest like that and you plan to live off of your portfolio, you probably should check your cholesterol and your blood pressure, because you probably are going to be living a very stressful life. Moving on, but it's different today. Agree Realty has reached fair value and has little upside left in this recovery. However, Realty income could still rise further as interest rates are cut and increasingly many fixed income investors come back to the REIT market and bid up their valuation. The valuation has nothing to do necessarily with the three arguments that you made. The valuation, you should have highlighted that in your 3 bullet points, or had it be the 4th bullet point, because this was not your bear case, the valuation. In fact, Realty income is especially well positioned to benefit from that, because it still offers a 5.2% dividend yield that's paid monthly, have been growing steadily for 30 years in a row. Realty income is also one of the most famous REITs in the world, and it's massive in size and has an A-rated balance sheet. Therefore, I expect Realty income to be the first choice for a lot of fixed income investors, whether it makes sense or not. Okay, that's the makes sense or not makes sense, because his bear case is its size and scale, that it's slow now because it's too big. But the A-rated balance sheet actually improves it. So this is kind of where it's a double-edged sword, right? It is a pro and it is a con. And he kind of highlights that there. So he does highlight that. So that's good. Not everyone follows REITs on a daily basis like me. We cannot expect the market is to be perfectly efficient at all times. And it wouldn't surprise if it bids Realty income back to the same multiple as Agree Realty. It would lead to a 20% upside from here. And this is why I'm now increasingly bullish on Realty income and don't have a strong preference for Agree Realty. Oh my gosh. It's just what was that famous quote from Warren Buffett? Looking at the share price is not investing. Okay, looking at the share price is not investing. Now, the valuation tracks the share price tracks valuation, depending on the market and all that good stuff. It's mainly a question of valuation. Agree Realty used to be a better deal, so it made no sense to buy Realty income, but following its recent outperformance, this isn't the case anymore. Now, a quick word still on Realty income's second quarter results. There weren't any major surprises. They slightly beat their quarterly expectations, reaffirmed their full year guidance. However, the good news is that management addressed some of the tenant issues that I made in my most recent update. As a reminder, some of Realty income's top tenants include Walgreens, Dollar Tree, and they're both closing stores right now. Moreover, they also own Rite Aid and Red Lobster properties, and these tenants are in bankruptcy right now. Realty income explained that while they expect to suffer some store closures, the loss of income shouldn't be significant, and they even shared their math. So this is what the management said. It is important to note that in total, the rent at risk from Rite Aid, Red Lobster, Walgreens, Dollar Tree, as well as At Home and Big Lots, which is 11 basis points of rent, represents in total only 2.3% of our portfolio annualized contractual rent through the year in 2026. That's really good. And if we achieve the recapture rate in line with our long-term average for bankruptcies, which is 84%, this suggests only approximately 37 basis points of rent is at risk of ceasing, or approximately 2 cents of adjusted funds from operation per share impact. So that's actually really, really good news. I own Realty Income in my portfolio, so that is really reassuring. So this is very manageable. It's still something to keep in mind because the negative headlines could impact its market sentiment, but as of right now, I'm not too concerned by this. Another piece of good news is the REIT keeps finding high-yielding deals in Europe with initial cash caps rates in excess of 8%, resulting in solid spreads over the cost of capital. The spread will only grow larger if and when interest rates are cut in the near term. Their internal growth combined with some spread investing should allow them to grow 4 to 5% annually going forward, resulting in double-digit total returns, even ignoring any potential upside from multiple expansion. And that's not too bad coming from an A-rated REIT. Very, very good if you own Realty Income. So finally, to conclude, I want to remind investors that valuations and fundamentals change over time, and therefore you should always be willing to reconsider your investments. No company is perfect, and each have unique pros and cons. In the case of Realty Income, the main issue in the last few years that its close peers were much more attractive. They offer better return prospects with lower risk, and therefore it made no sense to buy Realty Income. It resulted in strong outperformance, and I profited from this. But valuations have changed, and it is now too late for this opportunity. Realty Income is once again a good pick in the net lease sector, and I'm considering buying a position. I do not like this form of investing. Now, it is nothing personal against UC. I think his investing strategy, and many of you out there who share a similar approach of buying in and out of stocks, like if you're a dividend investor, this should make your stomach like hurt, right? Like this is not how you invest, in my opinion. Everything is subjective. This is just my opinion. This is not how you invest if you follow my channel and you want to live off your portfolio and you want really to live a stress-free life. And I mark this in red. You should always be willing to reconsider your investments. Absolutely, you should be willing to reconsider your investments, but not on a month-to-month basis. You don't flip-flop 4 times in 4 months. And once again, the main criticism of this article that I have is he listed very clearly 3 bullet points, the 3 bear cases for this stock. And he didn't address it at all, hardly at all, like very, very little. The bull case on buying the stock is now the valuation is better. Like that is, oh my gosh, to each their own. Let's take a look at some comments here, and then I'll wrap it up. So the first comment is, was bearish on Realty Income 9 months ago at $50, was bearish on Realty Income 6 months ago in the low 50s, was bearish 3 months ago in the mid 50s, but suddenly become bullish when it's $72. Just because ADC, Agree Realty, has run up higher. What the heck? Yeah, so that happened. And then UC responded here, because ADC was a better pick. This is explained in the article. It's all relative. Another one here, hey, usually you should have turned bullish on 49. No, it was a mistake to buy Realty Income, and then you should have bought ADC. It rose a lot more than Realty Income since then. Today it is different. Oh my gosh. Like this is the life of being a stock picker and making content online, is you just can't win. If you tell, like, how many times have we heard a buying opportunity of a lifetime and then the company cuts its dividend and they go bankrupt? Like that happens so often. That is why it is so difficult to be a stock picker and be an analyst. But I mean, that's part of being in the game, right? If you want to build a reputation and have strong opinions, you got to be prepared to take it on the chin when you're wrong. Another comment here, you see, why the heck did you wait so long? 3 months ago, it was $50 a share. Once again, his argument, this is why I don't like this, is his argument is sell Realty Income and buy ADC. As a long-term investor, like that just doesn't, it's a recipe for disaster. You're trying to time the market. You're trying to time the market and when to buy, which is hard enough. And you're trying to time the market and when to sell. You're trying to time both of those. And it's a very, very difficult thing. And that's why active managers, active investing has underperformed passive investing almost 100% of the time over a long period of time. Sure, in the short term, anything goes. But in the long term, decades, passive investing, I think statistically, it's like 100% of the time it outperforms active investing. So Yeah, a little late to the party. So all in all, I give this article a D. And the reason why I give it a D is mostly because of he highlighted the 3 bear cases and he doesn't really touch on them as why he's turning bullish. What I was hoping for is he highlighted those 3 bullet points, and then at the end of the article, he would have highlighted examples of each of those 3 bullet points of why they've improved in the last month. That's where I'm scratching my head. Like, how are all 3, when I first read the article, I was like, how are these 3 things all going to improve in just a month or 2 months? And that's why the article gets a D from me. Like, it's just focused on the valuation. It's pointing fingers at, looking at another company, and based off of another company, you're deriving a buy or sell for this company. Now, I do want to say we're talking about real estate investment trusts. We're talking about REITs, okay? In real estate, the valuation is based off of their peers, comparables in the market, right? And so I can understand why he's being a little bit more focused on the comparison, because generally that is how you value a REIT, is through comparables. That's why, hint, why MPW is struggling so much, because they're the only publicly traded hospital REIT. There's no other comparable. Okay. That's why diversified REITs are so difficult to measure, to value, because they're diversified. They hold different sectors, different industries within one single company. Okay. And so if you want to actively trade in and out of a REIT, then okay, this may be your approach. If you absolutely want to trade in and out of REITs, an illiquid asset, go ahead, be my guest. But honestly, I think, most people would be better off with this type of strategy, trading. I'm not calling this investing. This is by no means investing. Trading high beta growth stocks, right? Why do this with REITs? Low beta REITs. Like, I just don't get it. So yeah, this style of trading in and out of stocks is obviously not my approach, and that's why I'm very biased in my thoughts here and my opinions. And I love this quote from Warren Buffett. Money is like a bar of soap. The more you touch it, the less you'll have. And I believe it's the same thing with investing. The more you touch your portfolio, the less you'll have in your portfolio. Thanks for watching.